Hello and welcome. In this lecture video, I'm going to be talking about the accounting equation. I'll also define assets, liabilities, equity, and I'll talk about the different accounts that affect equity, revenues, expenses, owner capital, and withdrawals. And then we'll also walk through a few transactions and how they affect the accounting equation, okay? So this is core accounting knowledge, okay? So when we talk about accounting as a language, we need to define an asset and a liability and equity. And as you can see right over here, we have our accounting equation. And basically, this accounting equation has to stay in balance. It must stay in balance. If it doesn't stay in balance, there's something wrong. Okay? So what we say is that our assets, the organization's assets, equal its liabilities plus the equity. Okay? So let's define assets. And assets is a resource that a company owns that has economic value and can be used to generate revenue. So an asset, I'll be more specific, is a resource that a company owns or possesses that has economic value and can help us generate revenue. Okay? Examples: cash on hand, cash on the bank account would be an example of an asset for any organization. We could say supplies. We could say equipment, land, buildings. All right. So Mary Washington, where we have those golf carts that go around the campus, those are assets. They have economic value, and they are resources that Mary Washington possesses that have economic value and help them to generate revenue. Okay. Even though you like to hear companies say employees are our greatest asset, they don't mean asset in terms of the accounting equation. Okay. Employees are not assets in the accounting equation for the most part. There can be some situations with athletes where they're contracts. Okay. But for me, for example, I am not going to show up in the as an asset in the accounting equation for Mary Washington, even though they would hopefully say, Dave Henderson is an asset to Mary Washington. Okay, that's used in a different context. All right, that doesn't mean asset in terms of the accounting equation. So with Mary Washington, assets, cash in the bank account, the trucks that we own, the classroom buildings that we own, the land that Mary Washington owns. Those are all assets. Supplies that we have in the supply closet, those are assets. Okay. Another asset that a company could have is something called a receivable. So for example, let's go back to that example that I was talking about in a prior lecture video, that company A sells a product to customer B. And customer B says, I can't pay you now. I'll pay you in 2 months. And we said that company A can still record that sale even though they haven't been paid because of the revenue recognition principle. So what company A actually has is something called an accounts receivable. Okay, so a receivable is we're waiting to receive money. That's what a receivable means. An accounts receivable, we're waiting to receive money from our customer. We could also have an interest receivable that maybe we're waiting to receive a payment of interest to us. Okay. But receivables are also assets. Okay. So receivable means we're waiting to receive money in the context of a customer, with that idea of company A sells a product to customer B. Customer B says, I can't pay you now. I'll pay you back in 2 months. Company A has a sale, but then they also have a receivable. Okay. They also have a receivable. So that is called an accounts receivable, which is a type of asset. Okay. Liabilities, so we see over here on the next page, refer to what a company owes its non-owners, its creditors. Okay. So a liability could be, it's a future payment of products or services or cash. Okay. A liability also refers to a claim on the company's assets by its non-owners, by its creditors. Examples could be wages payable to employees, okay? Accounts payable to suppliers. So we're saying over here with wages payable, if we had some employees that worked and we haven't paid them yet, but since they have worked, we owe them their salaries. So that would be a wages payable. Typically, whenever you see the word payable, right there, see the word payable? That means liability, okay? So we owe our employees money. Accounts payable to suppliers. What this is saying is, let's say that we bought some supplies. We bought pencils and paper, for example, and supplies is an asset. So we bought assets, and then what we says, well, we told the company that we bought them for them, we can't pay you now. We're going to pay you in a month. So we owe them money. We have an accounts payable to that supplier. Notes payable to a bank. We take out a loan from a bank. And when we take out the loan, what do we get? We get cash. The bank gives us cash now. But then we owe money to the bank to pay it back in 6 months or a year or whenever. We have a liability to that bank in the form of a note payable. Okay? Note payable. We talk about equity. That's also referred to our capital, okay, our owner's equity, and it refers to the claims on the company's assets by our owners. So if we think about that accounting equation, right, assets equals liabilities plus equity, the assets, right, here the liabilities represent the claims on those assets by the creditors. Equity represents the claims on those assets by its owners, the creditors, non-owners, okay? And of course, equity would be equal to our assets minus our liability would equal our equity, just doing simple algebra right there with our accounting equation. Now, there are 4 accounts that affect equity. The first one is revenues. Revenues are sales of products or services to customer. So, with context of Mary Washington has tuition revenue. You know, students pay tuition to Mary Washington. That is sale. That is a sale for Mary Washington. That is revenue for Mary Washington. If you have a lemonade stand, my daughter has been doing some lemonade stands this summer. She makes a sale of a cup of lemonade. That's revenue for her business. Okay? Revenues have a positive effect on equity. So revenues increase equity. Okay? Revenues increase equity. So some examples, consulting services provided or tuition revenue. We make a sale of a product with the idea of the lemonade stand selling a glass of lemonade. That's revenue. Let's talk about expenses. So expenses decrease equity. Expenses decrease equity. Okay? What are expenses? They're costs of doing business. Okay? Expenses are costs of doing business. They are costs necessary to earn revenues. They are costs of doing business. And they decrease equity. What are some of examples of expenses? Well, supplies used. You know, I had to go get some more paper this morning to print off some of these notes. I'm using that paper, using the process of using the supplies. That's an expense. That's an expense. It's a cost of doing business. Okay. Purchasing advertising would be another expense. Mary Washington purchases advertising to advertise our grade school. That's another expense. Paying employee wages, right? We have to pay faculty and staff or faculty at Mary Washington to teach courses. That is called salaries expense. That's an expense. That is a cost of doing business. That is a cost of educating students that you have to pay the educator. Okay? Utilities, paying for air conditioning, paying for lighting on our classrooms. Those are utilities expenses. Those are costs of doing business. Okay, so expenses are costs of doing business. They're the costs that we incur to generate revenue. Okay, so expenses decrease equity. So remember, I was saying that there are 4 things that affect equity. So I've gone over revenues in this figure. I've gone over revenues. I've gone over expenses. Let's talk about owner withdrawals. So owner withdrawals decrease equity. Okay? They decrease equity. What do we mean by owner's withdrawal? Well, in a prior lecture video, I talked about the business entity assumption, and I said if Joe Plumber wants to buy a family car, he can't use the money in the business to buy the family car and then attribute that family car to the business. It's the family car. It's not for business use. So what does he have to do? He has to take out money from his business and move it to his own personal checking account. That process of taking out money from his business checking account and moving it to his personal checking account is an owner withdrawal. So he would withdraw money from his business account, move it to the personal checking account, and then use it from the personal checking account to buy the personal family vehicle. Okay? So owner withdrawals, they decrease equity, okay? Taking money out of the business. That's owner withdrawal. Owner capital is increases equity. Increases equity. And owner capital is adding money or any other kind of assets to the business. So investing money in the business, that's owner capital. Okay? So if you ever watch Shark Tank on CNBC, you have all these entrepreneurs that come up and they say to Mark Cuban and all the other Shark Tank, the sharks, they say, well, we have this great idea, but we need money. Why do they need money? To purchase more inventory, to expand operations, for more advertising. So they need money. And so what's going to happen is that when Mark Cuban invests in that company, he's going to give them money. Owner capital is going to go up. But now he's also part owner. Okay? So owner capital in that case is investing money in the business. It doesn't always have to be money. It could be other forms of assets. It's easiest right now to think of as just investing cash. So investing cash in the business. But as we'll see in later chapters, it doesn't just have to be cash. Owner's capital increases equity. So again, 4 accounts that affect equity. Revenues increase equity. Expenses decrease equity. Owner withdrawals decrease equity. Owner capital, which is owner investment, owners investing in the business, investing cash or other assets in the business, increases equity. Okay? So I'm going to end this lecture video now, and in the next lecture video, we're going to walk through a few transactions and how those transactions affect the accounting equation. Okay? Thanks so much.